Right, let's just dive straight into this. I want you to ask yourself a super important question right off the bat. Where is your cash sitting at this exact moment? Seriously, think about it. For a lot of us, especially young learners just starting to build up a solid financial foundation, we kind of just leave our money wherever it lands, right? Well, here's the hard truth we really need to face today. The Federal Reserve is quietly pulling the rug on high interest yields. If your cash is just sitting there idle, you're going to lose out. We're looking at a massive shift coming in the 2026 interest rate environment. And as students of finance, understanding the shift is literally the difference between watching your money stagnate and positioning your portfolio exactly like the smart money does. Okay, but before we get too deep into the weeds, let's quickly nail down some essential vocabulary. You're going to hear the term basis points, or BPS, thrown around a lot in financial circles. Just think of basis points like cents to a dollar. The golden rule to remember here is that 100 basis points equals exactly 1%. So if someone says rates are dropping by 50 basis points, that's really just a fancy way of saying a 0.5% drop. Make sense? Awesome. Let's keep building.
Welcome to today's Explainer. I am absolutely thrilled to have you here today. We're demystifying the 2026 interest rate drop. We're going to take these big, complex macroeconomic shifts and basically translate them into clear, actionable building blocks. By the end of our time together, you'll know exactly what's happening with the upcoming interest rate environment, how to protect your hard-earned assets, and most importantly, how to safely position your cash to actually profit from this massive shift.
So here's our game plan for today. 1. The core problem. 2. The inflation trap. 3. Strategy 1. CD ladders. 4. Strategy 2. The stock market. 5. Strategy 3. Real estate. And finally, number 6. Make your move now.
All right, let's jump into section 1, the core problem. The Fed is pulling the rug.
So the absolutely crucial number to watch right now is 75 to 100. The Federal Reserve has officially signaled multiple rate cuts throughout 2026, and we're looking at a projected drop of 75 to 100 basis points by year end. Remember our vocab from earlier? That means interest rates are projected to drop by 0.75% to a full 1%. Now, why does this matter to you as a student of wealth building? Well, if you've been enjoying those really juicy 4 to 5% yields on your high-yield savings accounts or money market funds, I hate to be the bearer of bad news, but those days are numbered. Banks are going to slash those rates almost immediately after each and every Fed cut. Moving on to section 2, the inflation trap, the monster eating your cash. Leaving your cash totally idle is actually incredibly dangerous. Think about it. If your money is in a standard savings account, which, let's be real, is the default for a lot of young people, it's earning a tiny, almost invisible 0.5%. Meanwhile, high inflation is out there acting like a hungry monster, just constantly chewing away at your purchasing power. If your cash is just sitting in that standard account, you've already been losing to inflation for months. And if your money is in a high-yield account, as we just established, you're about to watch that yield drop like a stone. A lot of people totally miss this, but the market actually prices these drops in months ahead of time. So by the time the Fed actually officially cuts the rates, the window to position yourself has usually already slammed shut. Which brings us to section 3, strategy 1, CD ladders. All right, here is how this first strategy builds out mechanically. Instead of taking all your cash and just throwing it into one single 12-month certificate of deposit, you stagger it. Step 1, you get a 3-month CD. Step 2, a 6-month CD. Step 3, a 9-month CD. And Step 4, a 12-month CD. So why is this such a brilliant move for young learners? Well, it's because you're locking in today's high rates before they vanish, but you're also keeping your liquidity. Every few months, one of these CDs matures, right? That frees up cash for you to either use or reinvest. Right now, you can still find 12-month CDs offering around 4.5 to 5%, but in 6 months, those exact same CDs might only be offering 3.5%. This latter strategy essentially locks the door before the high rates can escape. Let's look at section 4, strategy 2, the stock market. Now, this is where it gets really exciting. Historically speaking, dropping rates tend to trigger a massive 12 to 15% jump in equities. Why? Because when the Fed drops interest rates, borrowing becomes a whole lot cheaper for corporations. Companies can refinance their debt at lower rates, which instantly pumps up their profit margins. And that phenomenon, it typically fuels major stock market growth. Actually, if we look at history, in the 12 months following the very first rate cut in a cycle, the S&P 500 sees average returns of 12 to 15%. For a student playing the long game, capturing a 12 to 15% equity return is obviously way better than just sitting back and watching your savings account yield completely evaporate. But
hold on, we need to be precise here. Not all sectors benefit equally from a rate cut. Technology and growth stocks tend to really heavily outperform. And the reason is simple. When rates are lower, the future earnings of these tech companies become mathematically more valuable. On the flip side, though, financials and banks actually often underperform during these cycles. They make less money on what's called the spread, which is basically the difference between what they borrow and what they lend out. So this right here is a really crucial lesson in sector rotation. Moving to Section 5, Strategy 3, Real Estate. Let's look at the projected path of 30-year fixed mortgages. We're actually already seeing them dip below 6% in some markets right now. But as we learned just a few minutes ago, if rates drop another 75 basis points through late 2026, we could realistically see mortgages hitting the high 4s by early 2027. For anyone studying real estate or even just thinking about future property ownership, this timeline right here is your roadmap. And the real-world impact of this is just massive. Refinancing high fixed-rate debt can literally save you tens of thousands of dollars over the life of a loan. Every single percentage point you can shave off a mortgage is a huge deal. For you future real estate investors out there, lower rates mean significantly better monthly cash flow on your rental properties. Oh, and another quick lesson to note. If you're carrying variable rate debt, you're going to benefit automatically as these rates drop. But if you have fixed rate debt locked in at those old high rates, you actively need to explore refinancing options to take advantage of this shift. It won't just happen on its own. Finally, Section 6. Make your move now. Timing matters. I want to share this quote derived directly from our source analysis. The move is now, not later. There's a super narrow window of opportunity right now where informed investors are making their moves, while everyone else is still asleep at the wheel. If you wait until everybody else realizes that rates have dropped, you are going to be competing with a massive, overwhelming flood of refinance applications, plus a huge surge of new real estate purchase offers. Remember what we said earlier. The market prices these things in early. To win, you absolutely must act before the rush. So, my fellow students of finance, I'm going to leave you with this final question to chew on. Which strategy will you build first to strengthen your financial foundation? Are you going to play it a bit more conservative and lock in those rates with a structured CD ladder? Or will you shift your focus to equities and target that historical growth in the S&P 500? The landscape is totally shifting beneath our feet for 2026. The knowledge is now yours. How are you going to use it?